Hello, Baker investment students. We are quickly approaching the end of the course, so just stay on top of things. This week, for week 6, you're going to have your journal article, your second and final journal articles, so review. So just make sure to post out there in the week 6 post which journal you plan to review. That way I can just check it and give you feedback if needed. And then we also have some homework problems. I put a file out there next to in week 6 to help you with 12.3. Just kind of a little refresher on how to use the internal rate of return, but I've given you explanation how you find those cash flows. And then just stay on top of the forum discussion. And the following week will be a little bit lighter, just pretty much wrap things up, and I should have the exam ready by midweek for our final week. But just keep plugging along. Doing a great job in the forum discussions. Good discussion last week. Hopefully the coronavirus does not spread, but we'll see how the markets react this week. Overall, still, since you all have been in this course, the markets are still doing quite well. So, with the jobless claims coming out, I think it was a high of like 220,000 jobs added. Things are still looking optimistic for our economy. That flows over into the markets. So hopefully we can continue this path for 2020. And the Chiefs won, so that was super huge for the Kansas City economy. So that's always a boost to optimism. So good job, Kansas City Chiefs. So, well, I wanted to go over a few items this week to help you out with your readings. I think this week's readings aren't too technical. I think you get provided a little bit of an overview of the different types of mutual funds. You look at some of the returns, how those are measured, some of the components and details of mutual funds, and then you get a little bit more into investment strategy. And investment strategy can be personal for an individual, or it could be for an organization like a church or a corporation. So um, again, I think I had said that in the beginning of this course. There isn't necessarily a right or wrong way about strategy. You definitely want to reduce risk. Some ideally you want to try to maximize your returns, but to tell somebody that they're wrong, to be, oh, you're too conservative, you're all in bonds. I've done a lot of work with certified financial professionals, and really you're dealing with clients, and probably when you all, through your work, you have choices of mutual funds, you have choices of investments, that investment advisor should be giving you the best advice, but also listening to your concerns about what type of risk you take. Most people tend to be risk adverse. If I said to you that let's flip a coin, and if it comes up heads, whatever your salary is, I'll double it for the week. And if you lose, then you have to pay me your salary. So um, looking at that on paper and probability, there's a 50-50 chance. So do I really want to take that type of risk that I have to explain that, yeah, the mortgage payment is gone because I made a bet with the professor and I lost. So, but if the odds were put in a situation that said, hell, let's roll a 10-sided dice, and as long as the number 7 doesn't come up, I'll double your paycheck for the week. And you might say, hey, maybe I'm willing to take that risk, but if you did lose, you still have to explain. So what I'm trying to say there is that we're always trying to maximize our returns given the level of risk that we are comfortable with. So that is important. So, and just as we saw in 2008, a lot of people had lost a lot of money. It did come back quite a bit since that time period. So the good thing, the average of the stock market historically has averaged about 10 to 11%. So, but getting back to that, it's, what is my investment timeline? What is my investment horizon? What are my objectives? You think about some of those things that you look at. It needs, is it income? Is it capital appreciation? Is it managing risk? Is it looking at reducing my taxes? So our strategy is going to vary on that. And to give you an example, I'm invested from my boys since they were born in a Missouri Most 529 plan. For those on the Kansas side, there's a Learning Quest plan. But you can pick like an aggressive age-based strategy. So when they're born, they're in very aggressive stocks, and what the portfolio does automatically as they get closer and closer to college, it goes to a more conservative approach, but still allows for return, because you'd hate for your kid to turn 18 and then some crisis happens and all that money that you saved for all those years, half of it's gone. So maybe you're going to community college and not that Ivy League school that you had dreamed about. So, but again, it's again, going back to the concept, it's up to that individual and their risk tolerance. But ultimately, we're always trying to improve our standard of living. So, what is those best objectives? So, get back a little bit to the chapters. Like I said, mentioned with chapter 12, you're going to look at some of the different types of mutual funds. They're going to mention exchange traded funds. I think this was brought up in one of the forum discussions. And essentially, the benefit of the exchange traded fund is you don't have to wait until the close of the day, where mutual funds, we have one in Kansas City, American Century, they have to wait until the close of the day to come to that net asset value and then liquidate the shares. Or if I were to sell some shares to one of my Fidelity funds, I have to wait till the closing price until that's established. But the benefit of mutual fund, and I wish I had started one of these a long time ago too, because they said, I think right now there's over 79,000 throughout the world. And I can remember in the 80s and the 90s and keep on building up just how many mutual funds are out there. And you'll notice in your readings in the chapter, the authors are still telling us the same thing, and this ties back to efficient market hypothesis, is it's really hard to outperform the market. So like the exchange traded funds initially established by the S&P 500, and you'll see that in the readings that the S&P 500 is consistently hard to beat. So it's a diversified portfolio. There's really no rocket science. If you're a mutual fund manager, I always wanted to do this, was be an S&P 500 mutual fund manager, because you're just buying those stocks. There's no thought process to it. What a great job to have, to get paid to manage that fund. And really all you're doing is just buying those stocks exactly as it prescribes. But getting back to that point, with mutual funds, you need to be savvy about them and really understand the cost and the fees. The authors are very much about, research has kind of said that the difference between no load and load funds, there's no significant difference that load funds have outperformed than no load funds. So, and I know this was a concern probably about years ago, 4 or 5 years ago, especially in the Obama administration, was that people were really not understanding how much of the fees were eating away for their returns, especially for retirement. So there was some push in Congress for a little while. It kind of faded away. But they really wanted to help investors understand, that, hey, when you're buying into this fund, do you really understand the fees? Is that advisor really looking after your best interest? Or are they just trying to sell you something that's going to give them the most return for a sales charge? Or is the company, the managers of those companies, just making abnormal profits by misinformed investors? So whenever you're buying a mutual fund, and that's another thing with the S&P, because there's no thought process, the expenses are pretty low. So bottom line, my advice is, long run, when you're given those choices on mutual funds at work, at least have some of your money invested in the S&P 500 fund. At least through history, not many people would beat it. So, all right. You're also going to read a little bit about REITs, real estate investment trusts. Allows for either real estate gains or through mortgages, or somehow a combination of both. There's hedge funds that are exclusive to wealthy investors. They'll use derivatives that we'll talk a little bit more about next week. And they go through the different types of funds, depending on your objective. It could be growth, value, index, sector, bond funds. We spent a lot of time on bonds last week, but you can buy I have some through Fidelity. It's just a corporate bond fund, or it's an investment grade bond fund. So it's just part of your portfolio. But that kind of ties into chapter 13, is that, what is your investment strategy? The textbook provides some different examples about the percentage, maybe have an equity and one portfolio that maybe allows for movements in the market to be able to switch. But you really want to kind of determine, what is the right mix for you. And again, I'm saying that depends on the individual and where they are and what are their goals. So typically the longer that you have, probably the greater amount you want in equities, or what we call stocks, because they've historically have given the greatest return. But they can be balanced out with some different types of funds. Everything from a money market fund to bond funds, and then the most common is the equity funds. So But what you're also going to look at, and this ties in the homework problem, is a lot about the holding period return. So you're going to measure that. And then last, you're going to look at some different ratios, like the Sharpe ratio. You remember I put the video out there for William Sharpe. He has a ratio that basically looks at the portfolio return minus the risk-free rate over the standard deviation of that portfolio. And you'll look at a couple others, but the Trayon and the Jensen ratios. But essentially, the higher the ratio, the better the performance. So, all right. That's pretty much it for this week. But if you do have any questions, do email me. But we'll see what happens in the market this week. I'm hopeful that we'll continue what we'll see this past semester. And if again, if you do have any questions, just reach out to me and send me an email. Have a great week, and I'll talk to you online.